I was browsing the internet recently and I stumbled across this. It's from Hargreaves Lansdown and it breaks down by region the amount of people who are on track to retire with a moderate level of income in the UK. I'll get into what moderate means in a minute, but what surprised me about this was, across the country it was consistent that the percentage of people expected to be on track for that moderate income in retirement was always below 50%. Even in the southeast, the richest part of the UK. So what about the rest of the population? When it comes to pensions, the headlines at the minute are filled with chats of reforms, accords and talk of super funds. But is anyone actually sitting down with the UK population, with the average Brit and going, we're doing all of this behind the scenes because we're worried that you're not going to have enough in retirement, and sitting down with people and going, this is where you're at and this is where you need to be? The first thing we need to do is frame enough in retirement. We can do this through two broad measures that were set out by the Department of Work and Pensions in their 2023 analysis titled Future Pension Incomes. The first one is called Target Replacement Rate, or TRR. Simply, it's just how much of a person's income do they need to replace in retirement to maintain a similar quality of life to before they retired. It's a percentage of their income. And the idea being that most people in retirement will need less money than they needed when they were working. The IFS put together this breakdown of current TRR percentages based on 2023 levels. Notice how the percentage drops as you earn more. So if you earn 50k, say, the TRR measure would be an income of 30k a year in retirement, and that also includes state pension. The other measure is one that you've probably seen before. It's produced by the PLSA, and they're called the Retirement Living Standards. They look to basically answer how much does someone need today to live in retirement as a single person or a couple. This is where that moderate thing came from with the HL map before. If we look at the definition for each, so you can see at the bottom level, you're really just getting by. With moderate, you would have one foreign holiday a year. And if you do manage to get into the comfortable category, well then you can look forward to having a whole subscription to a streaming service. I mean, aren't you lucky? I'll leave those below so you can have a look. And I would encourage you to go through the PLSA Retirement Living Standards and say, what kind of life do I want in retirement? Build your own standard that's tailored to you, if you will. Because a lot of people are going to push back on them and say that they're too high, that you don't need that much money. Some of you might even think that they're not enough. What I would say is well done, first of all, for having your own view on what is enough in retirement for you. But what the TRR and the PLSA Retirement Living Standards allow us to do is put a flag in the ground, a measuring stick, and then measure the UK population off that and say, how are people doing based on these guidelines? And that's why they're useful. So let's do that. There are a couple of ways that we can view this. The DWP present this table, so it breaks down the percentages of people they expect not to hit either the TRR or the PLSA categories based on the decade that they reach state pension age. BHC and AHC stands for before housing costs and after housing costs, and speaks to the fact that for many of these assumptions, they assume that people will have a paid off home in retirement. The PLSA Retirement Living Standards assume this, yet 2 in 5 people now expect to rent in retirement, which will add further pressure on those retirees. And I really urge the PLSA to produce standards that highlight the impact of renting in retirement so that people can get an idea of what that means for them. But if we come back to this table, if we start with being comfortable, which I think is probably what most people envisage their retirement as if they close their eyes and picture it. You know, a couple of holidays a year, Netflix subscription, you can go out for a meal once a week, this kind of thing. The DWP, though, think that 9 in 10 people won't get to this level, and they assume that over half of the UK population won't get the moderate category either. Phoenix Insights is a think tank that looks at the impacts of living longer on our well-being and finances. They produced a paper called Tomorrow's Problem that looks at how people are doing with their retirement savings, and they put together this pie chart. It does a similar job to the table from the DWP that we looked at before, so it looks at people retiring from today until 2060, but it breaks them down into 5 categories. They expect 15% of people to fall into the financially struggling category. So this means that they would have an income below the PLSA minimum level. The undersavers are 38.5% of people that they think expect to be at that minimum level, but actually Phoenix think they will fall short. So that's 53.7% of the UK population that this modelling thinks will fall short of that basic living standard. I'm going to look at ways to fix this with you in a second shortly. I really want my channel to be a place that makes you feel good about your finances, but I also, have a responsibility to present the data as it appears. 13.9% fall into downgraders. So these are people that will achieve the minimum living standards, but it won't be enough to hit a TRR that is adequate for them not to see a large drop in their quality of life. Happily on track are those who expect to meet their needs, and this is just 14.7% of people. And what I think is the crux of this whole problem, and a key area for policymakers to focus on, is that 17.7% are just simply unsure about where they're going or what they're doing. The next few decades mark a radical change in retirements for the population of the UK. There are massive changes coming in basically how we pay for our retirements. Your parents or your grandparents might have had defined benefit pension schemes. So these guarantee a certain level of income in retirement. And those schemes, because of that guarantee, they naturally remove a lot of the responsibility away from the individual on planning their retirement and how much money they'll need. Whereas between now and 2060, we're going to see a shift where most people retiring are relying on defined contribution schemes, DC schemes. These are like the ones that most of the people watching this will have. Auto-enrollment work-based schemes. Obviously, if you're in the public sector, you might still have a DB scheme, but most people watching this are going to have these defined contribution schemes. And what that means is it's now on the worker to ensure that they have enough for retirement. And I think this is the big shift that's happening. And I don't think that the UK government and policymakers are communicating this clearly to people. Going, what are your expectations around retirement and are you saving enough? Are you going to be in a position where you get the retirement that you think you're going to get? Based on survey responses, the average personal pension savings goal in the UK is £253,701.40. And people intend for that to fund an annual retirement of £30,050.20. So the average person is saying, I want a 253k pension pot, and that's going to give me 30k a year in income. That average target pension pot set by UK retirees would only last 11 years in retirement, according to research from Retirement Review. We can see that a large majority of people in pre-retirement actually are not even at this goal. I will caveat this by saying that this is DC pensions only, so it doesn't take into consideration other savings and investments, and of course state pension, which is currently making up a large portion of retirees' total income. But it's clear here that the average individual is not making robust enough plans around retirement savings. Before we look at potential solutions, I'd just like to take a moment to discuss another type of planning that anyone who is a business owner should make with today's video sponsor. If you're building a business, have you ever thought about what would happen if you, a co-founder, or a key member of your team were suddenly unable to work or passed away? A recent study from Legal & General found that 59% of businesses would likely fold within a year if a key person died or were hit with a serious illness. So this is where our sponsor, Caspian Insurance, can help. They can protect your business and your wealth from these awful kinds of events. They have a range of products that can help. For example, relevant life cover. Business owners and directors can use this as a tax-efficient way to get life insurance because it's paid through the business instead of out of your personal pocket. Or another one is key person insurance, which covers the financial impact if a founder, senior executive, or key employee becomes critically ill or passes away. It helps keep the lights on and make sure the team gets paid. Or shareholder protection. So if a partner or co-owner dies, their shares typically pass to their next of kin, which can lead to all sorts of issues. So this cover makes sure the dead person's family gets a payout, but that the company isn't broken up or falls apart in the process. We talk about risk in relation to your personal finances on this channel all the time. But with Caspian Insurance, they can help you manage the risks of people within your businesses. If you'd like to learn more, speak to them, or check out what they do, I'll leave a link in the description and pin comment for you. Okay, I'm done scaring the crap out of everyone now. I am sorry about that. But what I think is clear is that policymakers, think tanks, those with all of the data are saying that the average Brit is heading to a position of a retirement that's probably significantly below their expectations. So where's the good news in all of this then? I want to focus on individuals and on policymakers and things that I think both can do. I do firmly believe that an individual, an average Brit, can have a really good retirement if they just engage with their pension. So I want to start there. Of the 12.5 million people that are under saving for their retirement at the minute, 42% reach more than 80% of their target income. Many of the people falling short of adequate amounts are doing so by not loads. And a small increase in their savings could be all that's needed to push them up a little bit. Fidelity produces a small amounts calculator where you can see how if you increase your pension savings by a fraction, the potential large impact that can have on the total amount that you end up with. I don't want to come across as insensitive to the fact that many people are struggling to just make ends meet at the minute, but I really want you to consider, can I just stick an extra £5 a month away here? Or just anything, because it can make a big difference. The Phoenix paper has some really interesting discussion on this point. So their modelling assumes that people save a consistent rate over their lifetime because available evidence suggests that the increases in average DC contributions as a share of earnings through working life is small. People just don't tend to increase their contributions as a percentage of their income by much at all. 2% of gross pay between early 20s and mid 50s And for all my ladies watching, you tend to be worse. You plateau around your mid-30s. It's this kind of mañana thing of, I'll up my percentage in the future, but people just don't. Every time you get a pay rise, ask yourself, can I up my percentage here a bit? One of the best things about auto-enrollment is that it took the choice away from people. It opted them into the scheme, unless they opted out. But the negative of that is this apathy that exists around the scheme of people assuming that 8% is enough. If you're younger, if you're in your 20s or 30s and you've been in the scheme for a while, it might actually be enough. But there are certain cohorts, certain age groups that are most at risk of being undersaved. The report points to the 2040s as being a peak period for undersavers. These are also the people who are likely to not have a DB scheme, but also be the ones who worked for a period without a DC scheme. 74% of people affected are individuals born in the 70s, 14% in the 80s. If you're in your 20s and 30s, the truth is that you've potentially already been in a scheme for years, and if you engage with your pension, get the most out of it, and up the percentage when you can, you might be okay. But for those of you who have worked for years and haven't had the auto-enrollment there and don't have a defined benefit scheme, you need to really look at this and go, am I saving enough here? I also don't want you to think that the answer is always you have to save more. I've made loads of videos about how to get more out of your pension without actually paying more in. Just simply logging on and checking that you're in the right fund, maximising employer contributions, getting to salary sacrifice schemes if there are some, claiming back the 20% tax relief if you're owed it because you're in a relief at source scheme. 80% of people eligible for that relief don't claim it back. Below and in the end cards is a playlist that goes over everything in detail for you. Just get really into your pension no matter what age you are. Treat it like you would your home because they're kind of like the yin and yang, the two pieces of the puzzle for your retirement. Your home, if you're lucky enough to own one and get one paid off, that will provide you shelter. Your pension will provide you absolutely everything else. Okay, now let's look at policy, because I honestly think that this is where the biggest improvements need to come from. Not from individuals, but from policymakers, from government, from the people in charge. If you've seen the news recently, you'll have seen announcements around Rachel Reeves' plans to increase the amount of mega funds in the UK by 2030. A mega fund is a pension scheme worth over 25 billion. The idea is that the scheme has the ability to invest in larger projects, reduce fees, get economies of scale. I mean, get this, there are 24,500 pension schemes in the UK with fewer than 12 members. So each of those schemes has a board of trustees, investment advisors, solicitors, accountants, just all these people sucking up all these fees and snouts in the trough, just destroying the ability of that fund to, operate well for its users, basically. Whereas if we compare that to the Australian model, they have a few dozen total. It's the Australian model that is being followed here. It's called superannuation, and I do think it's sensible to copy the Australians as they're a couple of decades ahead of us in terms of this sort of auto-enrolment, and their system's been working really well for them. Consolidation of our pensions makes a lot of sense. We do still need to make sure that there's competition in the market though, to drive down costs and to breed innovation. But, thousands of different providers is really inefficient. We want big funds with economies of scale that can go out into the world and invest in big infrastructure projects like the Canadians, like the Australians. What I don't like about these changes is the so-called legislative backstop. So Rachel Reeves wants the pension companies to invest a certain portion of their funds in the UK to help grow the UK economy. 17 of the largest pension providers have said, okay, we'll sign up to that in practice, but nothing is set in stone. This backstop means if the government aren't happy with the progress on that point, they can potentially force the companies to do it down the line.
So we are very, very concerned about the concept of kind of mandation. We think that would be a mistake.
That's the head of investment at Nest Pensions, one of the UK's largest auto-enrolment pension providers, saying what he felt about this 4 months ago when I interviewed him. In my opinion, pensions should exist to maximise the returns for the people with the money in the scheme. They should never be used to make politicians look good. If there are good investments in the UK, pension companies should buy them, but they should never be forced to buy UK assets regardless of the returns on offer. Political meddling in pensions like this is the exact opposite of what we should be doing, especially from a government that, quite frankly, people, mistrust or are sceptical of. Changing the rules constantly, moving the goalposts, and just fiddling with these things creates this sense of, I don't really know what's going on here, I don't know the rules, so I don't trust them. When Paul Keating introduced superannuation to the Australians in 1992, look at some of the language that he used. Superannuation is about giving Australians ownership of their future. It's your money, not the government's, not the employers', it's yours. It's your money as part of your wage, simply deferred to when you need it most. Rachel Reeves is treating UK pensions like it's her money, and that is a massive mistake. We need to foster a culture or a feeling of ownership in our pensions, because that is what will drive better outcomes for the UK population. Using the Australians for inspiration, here are some policies I think the UK government should be adopting. First of all, over time, we need to increase the minimum contribution to 12%, up from the 8% it is at the minute. It's at 8% and it was never meant to sit there permanently. It's just been stuck because I think governments are just too scared to pull it up. Use a combination of tax relief, employer and employee contributions to get there. The government should do everything they can to help with this, because if everyone retires with a terrible pension, the country is screwed. Like Paul did, we need to foster this idea of ownership and not see it as a burden, but as something that benefits everyone. So to help with this sense of ownership, currently the auto-enrolment scheme to many feels pretty invisible or in the background. If you log on, congratulations, most people don't. Instead, we should get employers to print on payslips the amount that's in the auto-enrolment scheme, so people can see, okay, well, this much went from my pension, but here's this other pot that I also own for the future that is mine, and look how big it is. As part of bringing funds together as well, we should insist on fee reductions. This is an area that the government should definitely get involved in. The only way to guarantee a better return long term is to reduce your fees. And for too long, subpar performance has been met with high fees in the UK pension system. The government should put in place stricter fee caps and provide much greater transparency around fees and the impact of fees on workers. And those workers should have more of a say on who their work-based auto-enrolment scheme is with. They should get to say, this is where I'm putting my money. Even better, create the pot for life system that was first suggested by Jeremy Hunt. This means then that a worker has a pot that follows them round. So whenever they go to a workplace, they bring their pension, again, ownership with them. It's not like, oh, we tell you who your provider is at this workplace. What this reduces is all of these mini pots everywhere that are currently spread absolutely everywhere around the UK, one for every job that you've ever had. And finally, we need to foster a sense of pride in our pension system, similar to the NHS or state pension, or our wicked sense of humour because we are hilarious. Run national ad campaigns. Get Martin Lewis on it. Just drive it home to people that this is yours, it's important, and it's on you to make sure that this works for you in retirement, because you work really hard. And when the time comes to stop working, you deserve so much more than average. Thank you.